Let's continue looking at the equity method here for accounting for investments. Pfizer Pharmaceutical paid $80 million on January 2nd, 2024 for 2 million shares of Karn Cosmetics common stock. The investment represents a 25% interest in net assets of Karn and gave Pfizer the ability to exercise significant influence over Karn's operations. Pfizer received dividends of $3 per share on December the 21st, 2024, and Karn reported net income of $52 million for the year ended December 31st, 2024. The fair value of Karn's common stock at December 31st was $30.50 per share. The book value of Karn's net assets was $208 million. The fair value of Karn's depreciable assets exceeded their book value by $32 million. These assets had an average remaining useful life of 8 years. The remainder of the excess of the cost of the investment over book value of net assets purchased was attributable to goodwill. Prepare the appropriate journal entries for the purchase through the end of the year. So again, we're looking at the equity method. Now, regardless of whether we do the equity method or the fair value through net income, the initial entry is exactly the same, except we may call it the account slightly different. For example, you may do like investment in equity securities for a fair value through net income, or you could use an investment in equity affiliate for an equity method, but it still goes into an asset account called investment in something. We're going to do equity affiliate because that's what our book uses, and then we're going to pay cash. All right, so how much are we paying for this? Well, it says that we purchased it for $80 million. So we're going to initially record our investment at $80 and our cash at $80. Now, how does that impact the financial position of the company? Well, this is an asset exchange. Our assets are both going up and they are going down. So this is a plus and a minus of 80 to our assets. All right. Now, it is not impacting the income statement at all. There's no revenues, gains, or losses there, or expenses. So net income is not impacted. Also, equity is not impacted. So we know income wouldn't be impacted in that as well. And then the statement of cash flows, what's going on here? Well, we do have a cash outflow. So our cash is going down by the 80. Now, is that operating, investing, or financing? That would be an outflow from investing activities. All right. Now, under this method, we also have to record our portion of that company's net income. Remember, under the equity method, we assume as the equity of the other company changes, so does the investment we have in that company. So does our ownership, so to speak. Remember, purchasing of shares is simply buying ownership. So as Karn Cosmetics equity goes up from net income, our investment should go up. So how are we going to record that? Well, first and foremost, we figure out our portion of the net income. So Karn reported net income of $52 million for the year. Now keep in mind, we only own 25% of that. So we're going to take our $52 million in income, multiply that by 25%. So of that 52 million, 13 million would be our portion of their change in equity. So how are we going to record that? Well, that is income, so our investment is going to be increased by the income of that company. So we're going to go in and we're going to debit our investment in equity affiliate, and then we're going to credit our investment revenue. Now, just to do our indents here, to make our debits and credits a little neater, we're going to indent that. And that is 13 as well. Now, how does that impact our financial statements? Again, that is just our portion of income. In that, our assets are going up because we've increased our investment account, and our equity is going to go up in the form of investment revenue. Now, this is investment revenue. It will show up on the income statement, so our revenues and gains will go up, and our income goes up. There is no cash flow. However, if you were doing the indirect method of cash flows, you would have to back this out as a non-cash item there. So keep that in mind. If you ever do the statement of cash flows, you would have to back that out as a non-cash out of the operating section because it's embedded in net income. Just like the fair value through net income, we also have to record any dividends we receive, and we're going to receive those. So in this case, they did declare, we received, $3 per share in dividends. So we're going to go in and we're going to show that we've received the cash there. And how much? Well, here, be careful. It says we bought 2 million shares, which represents 25%. Sometimes they say we bought 25% of their total shares. You have to multiply it out. Here, we own 2 million shares, and they declared a $3 dividend. So all we have to do is go in and do a $6 dividend adjustment. Again, the 2 million shares we physically own times the $3 per share dividend. Now, where's that going? Well, think about it. When Karn here pays the dividends, even when they declare them, but at any rate, when Karn distributes these dividends, their equity decreases. If their equity decreases, then our ownership in theory decreases, because we now have less in ownership because capital goes, their equity goes down. So our investment should also go down. So we're going to credit here the investment in equity affiliate for this transaction. So notice how we're not recording dividend revenue like we did in the other method there. We actually reduce our investment because our claims against the assets, the Karn's equity has gone down. If their equity goes down, then the owner's claims have gone down. And being an owner, our claims would be reduced. All right, so how does that impact us? Again, this is an asset exchange. So we're going to go in and we're going to increase and decrease our assets by the 6.0. All right, no change in our liabilities or our equity there. There's no revenues or expenses here when we're recording the dividend. What about our cash flow? Yes, we are going to have cash flow. Now, this could be, depending on the situation, operating or investing. I'm going to say this time that we're going to go with a inflow from operating because it's dealing with the dividends. Now, again, situations could dictate depending how we would treat that. All right. Now, moving on. Other adjustments. When we have the equity method, we do have to pay attention to the assets. If we had purchased this company, we would bring their assets on at fair value. If we brought them on at fair value typically is greater than book value, not always, but typically, which means depreciation for the year would have been greater. In other words, the net income of this company would have been less had they recorded additional depreciation as a result of bringing those assets on at fair value. So when we have a significant influence here, and we treat it as equity method, we do have to check and see if the fair value of the depreciable assets of the company we're investing in exceed the book value. Because had we purchased the company, we would bring those in at fair value. So here it says the fair value of Karn's depreciable assets exceed their book value by $32 million. So had we brought those on, we would take that $32 million, we would need to depreciate those, and at that point, as we depreciated, it would reduce the net income. So anytime that happens, when the fair value exceeds their book value, if it's a depreciable asset, then we have to go in and we have to make an adjustment. These assets have an average remaining useful life of 8 years. So again, their total assets fair value exceed by 32. So we're going to take that 32, we're going to multiply that by 25%. So 32 times 25% gives us 8. So of that 32, we would have an impact of 8 because we only own 25% in theory of the assets. And we're going to divide that across 8 years. So we're going to take that 8. We're going to divide it across 8, which is pretty easy to do, but you would get 1. So you would have additional depreciation expense of 1 every single year. So instead of $13 million in net income, we would have only had 12 because their income would have been $1 million less for our portion. So all we need to do is go in and reverse this down to 12. So we're going to go in and we're going to debit the investment revenue, and we're going to credit the investment in equity affiliate. Oops, I misspelled affiliate there. There we go. By 1. So that way the net impact to income here is 12, not 13, because we would have additional depreciation had we physically purchased this company. Okay? So in that, we bring that down. How does that impact us? Well, the exact same way. It's going to take our assets down by 1. It takes our equity down by 1. It also is a revenue, but we're debiting a revenue, so that's weird, I know, but revenues are going down and income is going down. There's no impact to the statement of cash flow. All right. Now, fair value adjustment comes into play. Well, under the equity method, there are no fair value adjustments. So this would be no entry in that case. Anytime you use the equity method, you do not adjust the fair value at the end of the accounting period. All right, so again, this based on this information, remember we did do investing here. You could also do operating. It is a dividend, so we can treat that in that respect, but since it's equity method, it would be possible to do investing or operating. So keep that in mind. There are exceptions to all rules as we go across the board. Any questions or concerns, please let me know.